Hey everyone, welcome back to another episode in the DIY investing education series. And as promised, in today's episode is part 2 of understanding covered calls and the covered call strategy. So in the previous episode, we discussed in layman's terms what a covered call strategy is, and I ended the video by telling you, okay, well, we're covered call strategy or doing a covered call overlay means you're giving up upside for those premiums, for that income, but there's really two factors that determine, okay, how much upside am I giving up, right? The first factor, factor number one, we'll start with the easiest one, is portfolio coverage. Portfolio coverage, right? So if you have 1,000 shares of anything and you're doing the covered call strategy, or you're writing call options on 500 shares, that's half of your shares. Well, that's a 50% portfolio coverage, if you will, right? Really, really, really easy to understand. It just means you're doing covered calls only on 50% of your shares, or 50% of the portfolio, right? So if you're doing it on 250 shares out of 1,000, that's 25%, right? It's not complicated at all. It's really straightforward. But does that mean, okay, if I have 50% coverage, am I giving up 50% of the upside? Well, that's not necessarily true, because that brings you to the second factor, the more complicated one to understand, but we're going to go through it together, everyone. I'm going to show you some examples. By the end of the video, you should be a master of the covered call strategy. You're understanding what a covered call strategy is. So by the way, if you have any friends or family that are trying to understand what covered call strategies are, how covered call ETFs work, make sure you share this video with them. So now let's discuss the second factor. So portfolio coverage is number one, right? Very simple. Second factor, the moneyness of the call options, the moneyness of the options. And as usual, the easiest way to explain this is with an example. All right, everyone. So I removed my face because I am paranoid that I'm blocking any text here. But the document we're looking at is a really, really good infographic showcasing, a covered call strategy by Global X Canada. And I'll show you where to get it in case you want to follow along. If you just go to any one of Global X Canada's covered call ETFs, if you go to documents, you'll see that there's this document here, the covered call infographic. So that is what I'm opening up now. So let's go through an example of an actual investor writing or selling a call option to another investor. So let's say there is a stock called XYZ, right? You have a stock called, or a company called XYZ, and the current price per share of this stock is $100, right? Very easy example. You have a stock called XYZ, and by the way, I know blocks that corporation stock symbol is XYZ, but this is just an example. It's not block stock here. So stock XYZ as an example, fictitious company here. Stock price is $100. And basically this is an example where the investor is selling a call option on that stock at a strike price of $105. So the strike price, and here's actually the whole transaction here. So essentially, if you have a stock at $100 and you're selling a call option to another buyer at the $105 per share strike price, that means that after 30 days, let's say the contract is 30 days, and most, a very common expiry date for a call option contract is 30 days. We're going to go over this scenario. Okay, well, what happens if at the end of 30 days, the stock is over 105, lands at 105 exactly, or is under 105? Remember, the starting price is $100 per share. So here's the option contract in this example. So Anna is the person buying the call option from John, who's selling it. So again, stock XYZ, current stock price is $100, but the contract, or the strike price, is at $105, right? Which means this technically is a 5% out of the money call option. That is the moneyness in this case of the call option, right? Very easy. 105 is $100 plus 5%, right? $100 plus 5% is 105, so it's 5% out of the money. The strike price or the agreed upon price is 5% out of the money, right? If it was 104, it would be 4% out of the money. 101, 1% out of the money. If it was $100, if the stock price is $100 and you're selling the call option for the exact same price, $100, that's an at the money moneyness. That's an at the money call option, right? So at the money, out of the money, in terms of percentage, now you know exactly what that means. So that is in short the moneyness of the options. It's relating to the strike price that you're selling the option at to the other investor, or the agreed upon price that you both agree to, which in this case is $105. So let's stick with this example. So you have a stock that's 100. You sell a call option to another investor at the 105 strike price, which again is 5% out of the money. And for that, as the seller of that call option, you get $3. That is your commission, or what we call in the options world is your premium. It's the premium of $3. So this is how covered call ETFs or a covered call strategy generates premium, or generates income. That income comes from those premiums that you get by selling these call options to another investor. So that means that within the 30 days, Anna here has the option, right, but not the obligation to buy the XYZ stock off of you if the price reaches $105 or more. So let's go through the three scenarios that could happen. So let's say at the end of the 30 days, the stock goes above 105. So let's say it goes to 106, 107, 110, 120, whatever it is. If it skyrockets, well, of course, Anna's going to exercise her right to buy the stock off of you for 105, because in the market, the price is 110 or 112, right? So she would much rather buy it at 105. So this option is going to be exercised, which means you're going to have to sell your stock to Anna at $105 a share. So of course, the stock was 100, you're selling it to Anna for 105, so you make a 5% profit technically there, plus you earn that $3 premium. Okay, Anna in her case pays $3. Let's say the stock goes to 110. For this example, let's just say the stock goes to 110. Well, you're basically giving up the appreciation between 105 and 110. That's you're giving up $5 per share in that example. So if it goes to 110, the stock price went from $100 to 110, you sold it at 105. So between 105 and 110, there's $5 there. You're giving up $5 of upside in this example, but you still sold it for 105, so there's still a $5 profit there, but you earned $3. You earned $3 as well. Anna, in her case, the stock is 110 in the market, and she's buying it off of you for 105, but she paid a $3 fee, right? A $3 premium. So her profit is technically $2, right? So she buys it at 105, it's worth 110, that's a $5 profit, but she paid you $3 in premium. So minus that $3, and basically it's a $2 profit for Anna. So that's what happens if the stock price within the 30 days rises above the strike price, in this case 105. If at the end of the 30 days the stock is exactly 105, well, in that case, basically, it doesn't, Anna could decide whether to exercise it or not, but it doesn't really matter because it's 105 in the market. So basically, this is a really good scenario for the seller of the option, for John, because the stock price is exactly 105, so most likely it's not going to be exercised, right? Because it's the same thing in the market. There's no point. You could just buy it 105 in the market, which means we earn, or John earns, right? The seller of the option earns $3, right? Regardless of Anna's decision. That's what it says here. So essentially, you could say that the option expires worthless, if you will, if it ends at the same price. At the strike price. And if the strike price, if the stock price ends up anywhere below 105, well, you get to keep your stock and the $3 premium, right? Because Anna's not going to buy it off of the stock off you at $105 if she could just buy it on the market at 104 or 103 or 102, et cetera, et cetera, et cetera. So in these two cases where the stock price ends at 105 or below, you basically get to keep the $3 premium. It's a $3 profit, if you will. But if the stock goes higher than 105, you have to give up your shares. And that is the second factor, everyone, the moneyness of the options. So the higher the strike price is, the more of a chance that you don't have to give away your stock, but the smaller the premium you're going to get, right? So if John basically sold the option at 104 or 103 or 101, the lower you go, the closer it is to the actual stock price, the more of a chance the stock has to hit the strike price. So your premium is going to be higher, right? The premium you're going to take in is going to be higher. So for example, let's say the stock price is 100 and he sold the call option at 100. That's an at the money option. Well, the premium you're going to get is much higher than $3 in this example, because there's much more of a chance that the stock is going to go above 100 than there is a chance of the stock going above 105, right? It's just simple math. So that, everyone, is the second factor that determines, well, how much upside am I giving up? So it's not just about portfolio coverage, because let's say if you cover 50% of the portfolio, it doesn't mean necessarily you're giving up 50% of the upside, because if the options are slightly out of the money, 5% out of the money, well, even on the portion of the portfolio that's covered, you still have a little bit of wiggle room to capture upside. In this case, 5%, because the call option was sold 5% out of the money. So there you have it, everyone. Hopefully you understand the two factors that go into determining, well, how much upside am I giving up? It's the two important factors you need to determine or look at when you're analyzing or evaluating a covered call ETF. Now, how could we put this information in practical terms? Well, Global X Canada is actually one of my favorite websites personally, because they actually disclose the percentage of the portfolio covered and the moneyness of the option, so you could clearly see exactly those two factors in black and white on what they're doing on all their covered call ETFs. So as usual, let's go through a few examples. Let's go through USCC, the Global X S&P 500 covered call ETF. If you scroll down, I'm always paranoid my face is blocking this. I shouldn't be blocking it here because that's the bottom. You see this thing here called portfolio investment metrics. And what you see here is the information on the coverage of the call options, of the options, which is the first factor, and the average moneyness, which is the second factor. So you see here that they're covering approximately 50% of the portfolio, and the moneyness is almost at the money. It's 0.07% out of the money. So this covered call strategy essentially means, and this could change every month, right? These are active strategies. If you go back to the infographic, and by the way, I highly recommend you read and go through all this infographic. It really talks in detail about the covered call strategy, etc. But you see point number 4, it's very important that you understand some ETFs do a passive covered call strategy, which is a rinse and repeat, and some people do an active covered call strategy. So an example of a passive or rinse and repeat strategy is, well, we're going to cover 40% all the time and always do 1% out of the money, right? If they just do the same numbers over and over, that's more of an active approach. A passive approach. An active approach means the fund manager is actually looking at a bunch of things. They're analyzing the market, and this is going to change a bit. The coverage and the moneyness could slightly change month to month. So the average coverage of this covered call ETF is just under 50%, and the moneyness is 0.07, which essentially kind of means you are actually giving up slightly less than half of the portfolio, right? Because if the portfolio coverage is 50% and the options are very, very close to at the money here, they're actually 0.07% out of the money. Well, you could say that it's almost as if that you're giving up half the upside, right? Because half is covered and the options are very close to at the money. Let's look at another example, the NASDAQ 100, QQCC. If we look at the options of the portfolio investment metrics here, you see that the coverage is also approximately 50%. It's slightly under 49, but the options, the moneyness of the options, the average is slightly above at the money, right? It's 0.28%. So it's a little bit more out of the money. You get a little bit more upside room than the previous ETF we looked at, right? And I forgot to mention in the last one, but here you see the average option annual yield, 3-month trailing average. So what they're trying to tell you is, look, by writing these options, this is the average option premium in terms of percentage, average, annualized, but average in the last 3 months of how much income or premium we're taking in. So by writing these options at approximately this coverage and this moneyness, they're taking in approximately 11.18% yield, right? So this gives you an indication of approximately how much yield they're taking in by doing this sort of coverage and option moneyness, right? Very interesting. I love that Global X really shows this information. What about CNCC? This is the TSX 60, so it's like the overall Canadian stock market. So again, you could look at it for all their covered call ETFs have this. You see that the coverage is approximately 50%, and the moneyness is slightly out of the money, here, less just after at the money, right? At the money would be basically zero, right? So this is 0.2%. And remember, everyone, that the amount of premiums that you take in depends on the volatility of the asset, right? So you could see that, for example, the Canadian stock market is it's not that volatile compared to the NASDAQ 100 index, right? The TSX 60 index typically has less volatility than the NASDAQ 100 index, which means there's less price movement. So the average coverage and moneyness is kind of similar. Let's just say it's kind of similar, but you see that on the QQCC, they're taking in way more premium in terms of percentage here than the Canadian stock market. You see that it's almost double or whatnot, right? So that's another important thing to remember, is that the amount of premiums you could generate is based on the volatility of the asset. So let's go through other examples. Canadian oil and gas stocks, right? ENCC, this is the Global X Canadian Oil and Gas Covered Call ETF. Now, oil and gas stocks tend to be more volatile stocks. So if we look at the investment metrics, if we look at the average coverage, you see it's actually lower than the other ones. It's 43.81. So they're only covering approximately, and this is, as of July, whatever, you have the dates there. This could change. They're covering 43.81% of the portfolio. So they're only doing covered calls essentially on 43.81% of the portfolio. The rest has no covered calls on it. And the moneyness is much higher here. It's 1.7% out of the money, right? It's 1.7%. So you have more wiggle room or more upside to capture. And this is because there's more volatility with these stocks. So they don't have to write as much covered calls, if you will, to generate the premium. You see, just with the options, they're generating approximately 12% yield. Gold producers are also typically a little bit more volatile stocks. So it's the same kind of thing here. You see that the coverage is at 41.5 and the moneyness is even way higher. It's 4.91. This is almost 5% out of the money, like the example we saw, right? So it's not just about, okay, well, what is the percentage of the portfolio that has covered calls? That's factor number one, coverage. But it's also the moneyness of the options as well, right? That the higher the moneyness, the more out of the money they are, the more upside you could capture, right? So that in a nutshell is an explanation of the two factors that you need to be aware of when it comes to a covered call strategy, to really understand, well, okay, I understand that covered call strategy or doing a covered call overlay means I'm giving up upside on assets that I own for premiums for income, right? That's the trade-off. But how much upside am I giving up? Well, it's those two factors. And another document, again, I highly recommend you check out and read the Global X covered call infographic. Really nice summary of covered call strategy, what it does, examples. It's really, really nice. And another document that's also cool you could always check out is the covered calls monthly performance document. This is updated regularly here. So I'm opening up the July 2025. And here you could see a summary of all Global X Canada's covered call ETFs and strategies. And you could see the average coverage, right? We saw a few examples. We saw CNCC, for example. We saw QQCC. And the average moneyness, how much out of the money are there? So you could, this is the two factors you need to be aware of to understand, well, how much upside am I giving up? And they even tell you, well, what is the average amount of premium that we're taking in percentage-wise annually, right? So I really like Global X, what they've done here in terms of their website. It's not always easy or obvious to find the exact strategy that each covered call provider does. Every fund manager does a slightly different covered call strategy, but if you dig deep enough, you need to find it. But those are the two factors you need to understand: portfolio coverage and the moneyness of the options, which Global X Canada displays right there for you for each ETF. Again, these are averages. They'll change month to month because Global X Canada uses more of an active approach. So give me a thumbs up. I'd really appreciate it if you enjoyed the video and you learned something from it. Again, check out this infographic. I'll put all the links in the video description below, but now you should fully understand the factors that go into a covered call strategy. Take care, everyone. See you in the next episode.